Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at PayPal.
If you find our talks useful, please consider subscribe, like, and comment underneath. And today we are really getting into a wild situation with PayPal.
Oh, absolutely. It's a completely contradictory setup right now.
Right, because you have this massive household name, and it's trading nearly 30% below its 52-week high, sitting right around $56.
Yeah.
But beneath that really ugly chart, there's this brewing narrative of, billionaire buyout rumors and just super aggressive insider accumulation.
It's the definition of muddy waters. You have the actual financial health pointing one way and the market valuation pointing the complete opposite direction.
Exactly. And to really unpack this wealth-building context, we're going to rely on some data from StockOracle today.
Yeah, StockOracle is this incredibly powerful AI-aided stock research platform we use.
Right, and we've got a special 14-day trial link below in the description for you to check out.
Just remember, it is an affiliate link, so the channel might earn a commission at no extra cost to you.
For sure. And we always have to say, this is not financial advice, right? It's not a trading signal service, and it doesn't provide real-time market data.
Exactly. I mean, AI insights and valuation estimates can be incomplete or just totally wrong, so always verify important facts yourself.
Always. So let's jump into the fundamentals, because this is where the disconnect is just massive.
It really is. I mean, if you look under the hood at the underlying business, it's operating like a stock that should be at all-time highs.
Wait, really? Because the chart looks like it's dying.
I know, but look at the trailing 12-month data. Revenue is actually up 5.79%.
Okay, wow.
Yeah, and their gross margin is holding really steady at around 40.93%. But the crazy part is they are retaining a net margin of 15%.
15% pure profit.
Exactly. In the fintech sector, which is incredibly commoditized, keeping 15 cents of every dollar is just remarkably resilient.
So they're basically a cash-generating machine.
100%. It translates to an earnings per share of $5.34.
And they aren't just sitting on that cash either, right? Management is using it for these massive share repurchases.
Right. They are aggressively buying back stock, which is mathematically huge for investors.
I always like to think of this, instead of that old used car lot analogy for cheap stocks, think of it like a loaded spring.
Oh, I like that.
Yeah, the market is pressing down on the stock price, but underneath these massive buybacks and those steady 15% margins, they're like the steel coils hardening.
That's a perfect way to visualize it because they have so much free cash flow. Every time the stock price drops, the buyback dollars go further.
Right, they can scoop up more shares.
Exactly, which shrinks the overall supply on the open market. So the earnings per share naturally inflates, making your remaining shares mathematically more valuable.
It builds a floor.
Yeah, mechanical floor. The more they push the price down, the tighter the spring coils.
So the spring is loaded, the balance sheet is rock solid, and yet the market cap is hovering right around $49.53 billion.
Yep.
With a price-to-earnings ratio of 9.79 and a price-to-book ratio of 2.47. I mean, that is priced for disaster.
It's pure pessimism.
So why is the market pressing down so hard if they're making this much money?
It really comes down to transaction margins. Wall Street is spooked because the actual makeup of PayPal's revenue is shifting.
Shifting how?
Well, their unbranded processing, mostly Braintree, has been growing super fast.
Right, Braintree. For those who don't know, that's like the invisible plumbing, right? Like when you enter a credit card on a website, but you don't actually click a shiny PayPal button.
Exactly. Braintree is just the unseen back-end architecture processing it. But that invisible plumbing is way less profitable than the branded checkout button.
Because with the branded button, they control the whole ecosystem.
Right. With Braintree, they're mostly just acting as a gateway and paying heavy interchange fees to other networks. So as Braintree gets bigger, the overall profit margin per transaction shrinks.
Ah, and the market absolutely hates margin compression.
They despise it.
But wait, their EPS is still over $5, so how are they offsetting that hit?
Management has been ruthless with cost cutting. They are trimming the fat everywhere so that even if they make a little less per transaction, the overall net income stays totally stable.
That sounds like a classic value trap to reversal setup.
It really is. Stabilizing the cash flow provides the foundation for that spring we talked about to finally snap upward.
So if the financials are actually okay and management is stabilizing the ship, why are investors still terrified?
Honestly, Fear of the future. The market isn't looking at what PayPal earned yesterday. They're terrified the moat is permanently drying up.
Right, the competition.
Exactly.
I mean, I had to push back a bit here because that fear seems totally justified to me. Aren't they bleeding out to giants like Stripe and Apple Pay?
It's definitely a hostile landscape.
Right, like you go to any new e-commerce site, and Apple Pay is basically the default. Stripe is powering everything. Why shouldn't you assume PayPal is just a dinosaur sinking into a tar pit?
Because you have to look at their structural defense mechanism. Their biggest moat is their two-sided network effect.
Meaning what exactly?
They connect millions of consumers directly to millions of merchants. Most competitors only control one side of that bridge.
Oh, I see. So Stripe dominates the merchant side, but I don't have a Stripe app on my phone to split a dinner bill.
Exactly. And Apple Pay has the consumers locked in via their iPhones, but they still rely on existing merchant payment rails to actually work. PayPal owns both ends.
And trying to build a two-sided network from scratch is, what, basically impossible today.
It's brutally expensive. But even beyond that, there are massive switching costs for merchants.
But doesn't that just delay the inevitable? If Stripe is better for developers, doesn't PayPal just slowly lead to death as old businesses die and new ones pick Stripe?
That's the existential threat, sure. But in enterprise software, ripping out PayPal's Braintree backend isn't just flipping a switch.
Right, it's deeply embedded.
Yeah, it requires completely re-architecting a company's revenue system. API integrations, database migrations, security compliance.
Like open heart surgery on their cash flow.
Perfect way to put it. If a major retailer's checkout breaks for even 2 hours during that transition, the lost sales completely wipe out whatever tiny fee-saving Stripe offered them.
Wow, okay, so PayPal is entrenched infrastructure, not just a button.
Exactly. And that infrastructure protects them far better than a $56 stock price implies.
Okay, so we've got this dominant cash-generating company trading at a massive discount. That kind of setup usually attracts the smart money. Right?
Oh, the smart money is all over this right now. The sentiment data is incredibly bullish, largely because of these M&A rumors.
Yes, the buyout rumors.
Yeah.
Let's get into the Wall Street drama here, because apparently Stripe, the exact competitor we just talked about, teamed up with private equity firm Advent and tried to buy PayPal.
Yep. And the board reportedly rejected an offer of $60.50 per share,
They called it inadequate.
which is a staggering signal to the market.
Think about the conviction there. Retail investors are panicking, wondering if the stock is going to zero, and the board looks at a $60.50 cash offer, which is a nice premium, and just tells them to take a hike.
They believe the intrinsic value is way higher, and they're putting their money where their mouth is.
The insiders are buying, right?
Aggressively. Over the last 90 days, insiders have net purchased 894,719 shares.
And almost 900,000 shares. That's insane.
Yeah.
How does that show up in the sentiment data?
We look at a metric called the Insider Management Sentiment Price Ratio, or MSPR. Right now, it's sitting at a strongly positive 64.47.
So the executives, the people actually seeing the daily transactions and the real margin compression, are buying heavily with their own cash.
Exactly. They see the same macro headwinds we do, and they're buying. And Wall Street is sniffing this out in the technicals, too.
Right, the volume data. We aren't just relying on rumors. There's a literal footprint.
The volume is the smoking gun here. The volume is running hot, operating at 1.51 times the 3-month average.
Okay, let's break that down for you. If 50% more shares are trading every single day than normal, that's not just retail traders messing around on their lunch break.
Definitely not. Retail doesn't have the capital to shift a moving average by 50% without a massive news headline.
So it has to be institutions.
Yes. Dark pools, hedge funds, algorithmic traders, they are quietly loading the boat. They are absorbing all the retail selling pressure, positioning themselves for a catalyst.
And the stock is actually up, what, 9.62% over the last 13 weeks?
Yeah, it's recovering from its low of $38.46. And even the pullbacks are bullish.
How so?
We just saw a 5-day pullback of 1.18%, but the volume totally dried up during that drop.
So when the price drops on low volume, the big institutions are basically refusing to sell.
Exactly. It's a low-volume consolidation, just a pit stop. Even analysts are taking note. Truist recently upgraded their rating on it, signaling the floor is getting harder.
Okay, so if you're holding PayPal, your biggest fear isn't the PE ratio. It's waking up to an alert that the Stripe buyout talks are officially dead, right?
Well, yeah, collapse deal is the primary bear case here.
So let's talk catalysts and risks. What's the downside if that headline drops?
If a formal announcement comes out saying talks are dead, you'd likely see a sharp gap down in price. All that speculative rumor money washes out at once.
And a gap down is brutal because you can't even use a stop loss. The market just opens 10% lower. But mechanically, how far can it really fall?
Well, this is where that fundamental floor saves you. Even if the rumor money leaves, you still have a 9.79 PE, massive buybacks, and 15% net margins.
You aren't falling out of a window, you're just tripping off a curb.
Right. The valuation is already so compressed, there's a massive structural cushion.
What about operational catalysts? Beyond the M&A drama.
Q2 earnings are huge. The market is laser-focused on total payment volume, and crucially, proving that the Braintree margin compression has finally stopped.
If they prove margins are stable, the market has to re-rate the multiple higher.
Exactly. And look into the macro environment, there's the potential for Fed rate cuts in late 2026.
Cheaper borrowing means more consumer spending, which flows straight through PayPal's toll booth.
It's a rising tide for their whole business. When you add up the fundamentals, the insiders, and the macro setup, it earns an 8 out of 10 bullish score for a 1 to 3 month swing horizon.
It's just a highly asymmetric setup.
It really is.
But, processing all this, the margin stabilization, the insider ratios, institutional volume, it's way too much for a normal spreadsheet.
Yeah, it's impossible. That's why AI research platforms are so essential now. They act as a water filtration system for this massive fire hose of SEC filings and rumors.
Right. And StockOracle tracks, over 15,700 U.S. listed and OTC securities.
Yeah, and it utilizes 468 financial metrics per company, standardizing everything through FactSet. It's incredibly thorough.
The feature I think really highlights the PayPal story is OracleValue, the automated valuation modeling.
Oh, absolutely. Because when human emotion takes over and panics, OracleValue runs 9 different intrinsic value models, including discounted cash flow, to find the mathematical truth.
Let's actually explain that. A discounted cash flow, or DCF model, is basically the AI projecting how much free cash PayPal will make over the next decade, right?
Yes. But money tomorrow is worth less than money today. So the model applies a discount rate to those future cash flows to calculate what the entire company is objectively worth right now.
So when PayPal is trading at a PE of 9, but the DCF model says it should be worth double that, the AI immediately flags the discrepancy for you.
Exactly. It also has this AI mode analysis feature, which automatically tracks the exact threats we talked about, like Stripe, and compares up to 30 stocks side by side.
But we do need to ground this in reality, right? These tools are amazing, but they organize delayed data, like 15 minutes for U.S. stocks and end of day for OTC.
Yeah, you have to be careful. They do not place trades for you, and it is definitely not financial advice.
And the models can be wrong. The classic garbage in, garbage out problem.
Precisely. If the AI assumes margins stay at 15%, but a new regulation drops them to 10, that valuation estimate is suddenly totally obsolete.
The tool augments your research, but the critical thinking is still up to you.
Always.
So bringing it all together, we've got this insane tug of war, a legacy cash machine protected by enterprise switching costs, trading at a huge discount.
While the market is just paralyzed by the fear of margin compression and Apple Pay.
And right in the middle, a potential hostile takeover battle.
It's fascinating. But, zooming out, I think there's a final, broader question for the long-term view here.
What's the bigger picture?
We spend all this time debating if Stripe will kill PayPal. But what if the whole concept of a payment gateway just becomes obsolete?
Wait, obsolete? How?
Think about central bank digital currencies or really stable blockchain networks. What happens when consumers can instantly transmit digital dollars straight to a merchant's wallet with 0 intermediary fees?
Oh, wow. That would be a nightmare for the entire fintech sector. If the Fed just issues a digital dollar to your phone, PayPal's whole two-sided network and even Stripe's backend, it all just becomes unnecessary friction.
Exactly. The ultimate disruptor isn't a faster gateway. It's the tech that bypasses the gateway entirely. The moat is never as deep as you think.
That is a wild thought to end on while we wait to see how this all plays out, because a blurry chart doesn't mean the engine is broken. Always double-check the vital signs yourself.
For sure.
All right, that's it for today's talk. Don't forget, if you want to try out the AI tools we discussed, grab that special 14-day StockOracle trial link down in the description.
Thanks for joining us, and please remember to subscribe, like, and comment below.
We'll see you next time.